When I say the words options investing, I usually get one of two responses. First one is that of concern. Options investing, isn't that like super leveraged derivatives? What are you, a gambler? See, options have generally a bad rep, and maybe with good reason. After all, our friends at Wall Street Bets have taken over the casino and turned the options market into some sort of roulette. There are plenty of horror stories, and though some of them can actually be kind of funny, there are a lot of them that are just plain sad. And just like there are sad stories, there are stories of people hitting it big. After all, people would not be doing this if there wasn't the chance of getting a huge payout, even if it's super slim. Do options have a bad rep? Yeah, they do. Do they deserve a bad rep? Not necessarily. See, just as options can be used for gambling, they can also be used to form really interesting payoffs. Payoffs that don't have to be risky necessarily on their own. Payoffs that may actually reduce risk at the portfolio level. So if concern is one of the reactions I get, the other reaction I get is usually that of confusion. And that is because options are complex derivatives, especially when formed with other options to formulate these interesting payoffs. Valuing options can also be a headache. Even the terms sound dreadful. Black-Scholes-Merton, put-call parity, binomial tree models. What is going on? But fear not, here at Alpha Architect, our number one mission is to empower investors through education, and that's what I'm gonna do here. I'm gonna go through the basics of options so that you can understand what they are. So what is an option? To simplify things, I think we should start talking about call options, and then we'll move on to put options. So a call option is a contract where the option buyer has the right to buy an underlying from the option seller at a pre-specified price on or by a pre-specified date. Simply put, a call option is the right, but not the obligation to buy something, hence the name option. Obviously, if you are buying the right to do something, you must be paying for that right. So here's the first rule of options. Buyers pay sellers a specified premium for an option. So if the buyer has the right but not the obligation, the seller must have the exact opposite structure. In a call, the seller has the obligation to sell the underlying to the buyer if the buyer decides to exercise the option by or on the expiration date. As you can see, options are a zero-sum game, meaning if someone is earning money, the other person must be losing that exact amount of money. However, this right that the buyer has purchased is not perpetual. It must expire by a certain date and time. This is called the expiration date, which is the last date an option can be exercised. When an option is exercised, the buyer has enforced this right to get the underlying, so the seller must deliver the underlying at that time. Now, it's important to note when options can be exercised, and here we're gonna talk about two different things. The first one is the American style option. First of all, has nothing to do with geography. You do not have to be in the States to purchase an American style option. In an American style option, the buyer can exercise the option at any time before expiration. On the other hand, if an option can only be exercised upon expiration, that's what we call a European style option. Again, nothing to do with the continent of Europe. This distinction between an American style option and a European style option can come in handy when we want to avoid early exercise risk. But in general, option buyers do not exercise their options before expiration. If an investor were to exercise an option before expiration, they're gonna lose what we call time value of money. See, part of the value of the option and part of the price that the buyer paid for is for the time before the option expires. If a buyer were to exercise that option before expiration, they are simply giving up on that time value of money. Usually, when a buyer wants to close the position, they will usually just sell instead of exercising. Lastly, let's talk about the pre-specified price or the strike price. The strike price is the agreed upon price at which the call option buyer can buy the underlying. Let's put this in perspective. Let's say that you want to buy a call on a stock, currently trading at $100. You buy the option with 6 months to expiration at a strike price of $100. Since the underlying is trading at $100 and your strike is $100, you have bought an option that is at the money. If the stock were to drop to $95, you are now out of the money, which simply means that exercising the option would make no sense. You would be paying $100 for something that you could buy in the market for $95. So if the stock were to jump to 105, the option is now in the money, which means that you could theoretically exercise the option at a gain, since you can buy something that is trading at 105 for $100. Remember, if you were to exercise this option, you would only pay $100 for the stock. Although in this example, the value of the option is a gain of $5, the profit of the buyer will likely be less than $5, since remember, the buyer must have paid a premium to enter into the option contract. Let's say for this example, the option buyer paid $5 for the option premium, and the stock is trading at 105. Even though the value of the option is $5, the option cost the buyer $5, so the buyer is just breaking even. On the other hand, the seller has not lost any money on the contract just yet, since he's received $5 and must pay back $5 on the value of the option. 105 therefore is what we call the break-even price. So far, we've only talked about a call option, which gives the buyer the right to purchase the underlying. So generally, we think of this person as bullish on the underlying. The other option we have is a put option, which is a contract where the option buyer has the right to sell an underlying to the option seller at a pre-specified price on or by a pre-specified date. If an investor buys a put, we can think of them as bearish since they can benefit if the price of the underlying drops. Let's put this in perspective once again. So similar to the last example, let's say that you buy a put option on a stock currently trading at $100. You buy the option with 6 months to expiration at a strike price of $100. Since the underlying is trading at $100 and your strike is $100, you have bought an option that is at the money. If the stock were to jump to 105, the option is out of the money. It would make no sense to exercise this option since you would be selling a stock that is currently trading at 105 for $100. If the stock were to drop to $95, you are now in the money. You could theoretically exercise the option at a gain since you can sell something that is trading at $95 for $100. Although in this example, the value of the option is $5, the profit of the put buyer will likely be less than $5, since remember, the buyer must have paid a premium for that option. If the option buyer paid $5 for the option premium and the stock is trading at $95, even though the value of the option is $5, the put option cost the buyer $5, so the option buyer is just breaking even. On the other hand, the seller has not lost any money on the contract since he's received $5 and has lost $5 on the value of the put option. $95, therefore, is what we call the break-even price. Which leads me to the second rule of options. Long calls and short puts benefit from appreciation in the underlying. Long puts and short calls benefit from depreciation in the underlying. Let's go a little deeper and look at the potential payoffs of each of these structures. So here is the payoff structure for a long call. As you can see, from the time the buyer enters into the position, they are at a loss because they paid a premium, so they can lose that premium. However, that's all they can lose. They can only lose the premium that they paid. The potential gains in this are actually infinite because as you can see, the underlying could just keep moving up and theoretically it could go up to infinity. So it has theoretical infinite gains and capped losses. Now, moving to the short call, and we're going to be talking about a naked short call, meaning the seller of this option has no collateral. As you can tell, this is the mirror opposite of what the long call is. You start off with a gain from the time the position is entered because the seller has received a premium, but the losses are theoretically infinite. Remember, we're talking about a naked short call. Moving on to the long put, same thing with the long call. When you enter the position, you are paying a premium, therefore you are at a loss. However, as the option starts moving in the money, you can see that there is some profit to be garnered. Unlike the long call, however, you can see that the profits are not theoretically infinite because the underlying can simply go to zero and that would be the end of it. The max profit of the long put buyer would simply be the difference between the strike price and 0 minus any premium paid. Going now into our naked short put option, remember naked meaning there is no collateral for the seller. You can see it's the mirror opposite of a long put. The put seller has a small profit to gain right from the get-go since he's received premium from the long put buyer. However, as the underlying starts moving towards 0, the put seller is going to start realizing losses. So you could see a developing theme here. The option buyer has a small chance of really explosive returns, while a naked option seller has the potential to explode if the position moves against them. Which leads me to the third and final rule for this video. The more unlikely a payoff is, the higher the payoff amount. This should make intuitive sense. If something is unlikely to happen, then it should be cheaper to purchase because the option could expire out of money. On the other hand, if it pays off, it should pay off big. Let's dig deeper to find out why. Let's say a stock is trading at $100 and you have reason to believe that the stock will drop. There are two put options you are eyeing, both expiring in 3 months. The first one is a $90 strike put that costs you $4, but you are also eyeing a $30 strike, each costing a penny. Remember, this makes sense because it's more probable for the stock to drop $10 than it is for it to drop $70. You have a $12 budget, so now you have a choice to make. You could purchase 3 options at a $90 strike, or you could purchase 1,200 options at a $30 strike. Maybe you could do a mix of both. Well, think about it. If you purchase the 3 options at a $90 strike, your max profit would be $258. That is 3 options purchased times the difference between the strike and 0, 90, minus $12 paid for the premium. Not bad. But if you bought the $30 strike, your max profit would be $35,988. That is 1,200 options times the difference between the strike and 0 minus $12 paid for the premium. Now, it's important to understand that the $30 strike is cheap because it is so unlikely that this payoff would happen. This is all due to convexity, and convexity can be a really complex subject to understand, but think about it as non-linear payoffs. See, for a highly convex option position, as the underlying changes, the price of the option doesn't change linearly, but accelerates as the underlying price changes. Convexity, then, is the key to achieving explosive payoffs, and this, my friends, is the key to tail hedging. If you want more content like this, a couple places you can head. First, go to alphaarchitect.com/subscribe. There you can subscribe to the blog where we have tons of resources for education. And secondly, you can follow me on Instagram and TikTok at Coffee Hour with Jose. See you there if TikTok is still a thing by the time I release this video. See you next time.